But I think that's the issue, is whenever you get that good news, interest rates can't be far behind. The reality is that the consumer, particularly in the US, is expecting inflation now. In a Gallup poll, inflation is no longer top of the laundry list of concerns. It's kind of around there with guns, which of course are serious, but the top concern is state of the government, state of the general economy, but cost of living and inflation has sort of fallen down the ranking. And what consumers are doing is they're simply absorbing prices. So I think the CFO of Procter & Gamble for the Q1 earnings season said, our elasticity, the elasticity of our customers in aggregate is looking good. So consumers are simply absorbing it. And I think that for the Fed is a bit of a signal that, hey, maybe we're not done yet. Yes, inflation's down to 4.9%, but the target's 2%. And consumers are expecting it, and therefore I think more needs to be done. And there's this sort of complacency around, well, actually, maybe they're done at this point. But I think there's more to go, so we're going to see possibly more pain.
I think you're right about the line of confusion. But the problem is, if they're not worried about inflation, I think they're worried about recession. I think they're beginning to see the shoe drop on that one. I'm sure you saw Home Depot overnight as well. Revenue dropping, guidance cutting, negative first quarter as well. That's the real cutting edge, cold face of the US consumer, if Home Depot is flagging up all these things as well. So that's my first point, which I want you to respond to. And the second point, perhaps in the same answer, is the market complacent? I know that if we have a look at 7 or 8 big S&P companies, the valuations are still pretty high. But if you strip that out, are valuations actually that complacent?
So I think on the first point, the Fed's priority is not going to be growth per se. It has got to be inflation as it comes in, as they see it. They are still 3%, nearly 3% above target. That has to be dealt with. And the only tool they have got to deal with that is monetary policy. So I think there is going to be pressure. And you've seen some comments just come through from some of the Fed board members that actually there is more to be done. So I don't think that's the fact that there's a little bit of slowing. I know Home Depot, they're selling fewer kind of sofas. That's where their higher margin is. It's on the kind of more permanent things in your home as opposed to paint, apparently. Things where you can do a little facelift, that's still strong, but things which cost a bit more, permanently upgrading your home, that is starting to slow a bit. But I think it's too early for the Fed to say, hey, we need to avoid a recession at this stage. It's still, the consumer's still in good shape. On valuations, certainly for the S&P 500, they're still relatively elevated. They've come down a little bit, but I think they're still relatively elevated. The Nasdaq, of course, has got very excited about artificial intelligence, and obviously that's a whole other subject. But I think that's yet another concern, and that yet the market just continues to grind upwards. And look, structurally, long-term stocks, the place to be, the best place to get growth, the Siegel constant, all those good arguments. But I think tactically right now, it doesn't look that exciting. And I think there are things that short-term investors can look at, VIX futures, for example, maybe a little play on the VIX popping up. That might be quite an interesting one. You can get a bit of upside for not too much premium right now. And if you're going to see more volatility, that's where it's going to play out. So there are some interesting things one can do tactically. But otherwise, I think staying kind of neutral to equities and holding that structural allocation and waiting. And in the meantime, you are paid to wait. The point is the T-bill is giving you quite a good yield. You're literally being paid to wait. And yes, T-bill's not risk-free around that debt ceiling because that's where you will see the pain if there is a default. But I think that's almost unthinkable, actually.